Yeah, so in this Feb, I moved over completely and I'm in the private debt alternative credit space.
And who's that with?
Riverrock.
Okay.
Yeah, so they're a European-focused alternative credit manager, sort of more of an investment boutique, trying to exploit various niches in the market with SME lending, working capital lending, and the business has seen a huge growth in these areas, especially during this COVID period with lending to sustainable businesses.
Yeah.
There's demand for those businesses, and those businesses have actually done very well throughout COVID. You know.
Did they jump in where more traditional banks lending was a bit slower?
Exactly. So, as you know, a lot of banks have retrenched post 2009. They've retrenched, and this has created an opportunity for private debt firms like ours within the alternative credit space to lend to these institutions. And where the niche or where the demand is in sustainable investing. So whether it's energy efficient lighting, whether it's recycling, energy conservation projects, environmental friendly projects, those sort of strategies have seen just a phenomenal growth across the board, across managers.
So you've got a bit, there's the ESG angle there as well.
Oh yes, yes. I think if you want to survive in today's market, you sort of need to be not just ESG compliant, but have a positive ESG filtering, on your strategies and working with the end investor who are obviously demanding these strategies and the businesses that you're lending to. In our case, we're lending, working with them to ensure that they are, implementing ESG across their businesses. So when you bring that together, that really creates a very attractive strategy for investors.
And how are they breaking it down? Do they have specific strategies they lend to via a fund, or how is it?
Yes.
SPV or?
Yeah. So it's a combination of things, depending on obviously the client preference and their size. But it's through a number of structures, so Luxembourg funds, special SPVs, managed accounts. So it's a range of structures. And then they are tailor-made and customized according to the client's preference. So they may be targeting specific SDGs, so sustainable development goals within that. So we'd work with the client to make sure we achieve those for them. So for example, within our working capital vertical, which is our trade finance vertical, we're lending to SMEs to help them grow their business. So, lending, whether it's pre-shipment or inventory financing, we're lending to them to enable growth in their business. And a lot of these companies are in emerging markets. In many ways, they're far behind developed markets with regards to implementing, various sort of social and governance and environmental policies. So companies like us play a crucial role in working with them to ensure that they can improve their local infrastructure, by creating decent work opportunities, making sure that there's gender equality, they're not employing children to work in their factories and businesses. And then the environmental factors, are they polluting the environment, polluting, their rivers and seas by dumping, industrial waste? So there's a number of angles.
Interesting, so it's quite comprehensive.
Very comprehensive, yes. So.
And do they have geographical focus, or is it kind of global?
So we are a European focused firm, but some of our strategies have an EM focus.
Okay.
So we don't have any US focused strategies because we feel that space is quite crowded already, and US direct lending started way before European direct lending. So European direct lending isn't as mature as the US space. So there's more opportunity. And since our focus, we're based here, people in the team have experience for European lending. We sort of stick to that.
And what's the investor base like? Is it institutional, family office?
Yeah, it's pretty institutional. So all the way from pension funds, endowments, all the way to family offices and private banks. So it's quite diverse. It's quite varied.
Really, you've got private banks coming in.
Private banks coming in, yeah. So their clients are now requesting for sustainable impact strategies. So they feel the need to have that in their bucket list to be able to offer that.
What's the kind of standard structure for a private bank client? I imagine that's pretty much straight into the fund, or
So that they would typically come in through a private bank, depending on the bank, through the private bank's platform.
Okay.
And the private bank either may run an SMA with a manager like us, or may make a direct investment in the fund on a club deal basis. So they may sort of gather a few clients on their end because they're typically smaller ticket sizes, and then make a big allocation into a they typically have preference for liquid funds. So that's where I feel, so as a firm, we have both closed and liquid end funds that they fit in well within the working capital space, because not only is it liquid, but it offers high single-digit returns. And as you know, the market's been pretty uncertain throughout the pandemic. So a lot of investors are looking to put their money to work in liquid strategies where they feel the risk is low, and the working capital angle is quite appealing to investors from a financial return perspective, but also from a impact in perspective with a firm like ours targeting all these sustainable development goals. So it offers both.
And it feels like when I was raising money for hedge funds, raising money from a private bank was a very hard thing to do because we weren't one of the private bank's product, and it couldn't be wrapped up and it couldn't be built exactly for them. An SMA for a private bank was an unusual thing. Are you seeing that more common now? Is that more common in general, more common relative to what you're raising money for?
Yeah, I'd like to say it's not necessarily more common, but based on two things: the size of the investor, the complexity of what they need, and what they're comfortable with. So we tend to find very large institutional investors tend to go for that. Private banks, maybe some, I couldn't make a general statement across all private banks, but typically very large clients tend to prefer a SMA type of a mandate, because they can customize it and they control the mandate rather than the investment manager.
Okay.
Because they're effectively they're signing the ISDA, they're in control of that.
Nice. And what kind of return profiles are we looking at?
So our strategies typically run from 4% all the way to low teens. So for the closed-end funds, higher up the spectrum, for the liquid strategies. So we start off with insured liquid strategies, which are at about 4%, moving up the spectrum. If you remove the insurance and looking at the supply chain angle, that's more of a 7% angle, and then all the way to 10 for real asset strategies, and then up to 12, 13 on the special sits type of strategies.
Okay.
So
we sort of on that spectrum, is it more kind of family offices up at the double-digit end and institutions down the bottom?
I don't think they're looking more so much from a return. Obviously is an important factor, but they're more looking at what fits within their asset allocation. We tend to find family offices of a certain size tend to prefer more liquid structures. So they tend to go for what's as I said, what's very attractive right now is a supply chain angle, because you're getting similar returns, or maybe just shy of a couple of hundred basis points, but a very liquid structure, rather than locking your money away, for multiple years. But again, a very large family office would probably look at a closed-end direct lending fund. Having spoken to many over the last few months, they're increasingly looking at the private market space in general. Not necessarily private debt, but just the private market space, because they know that there's a lot of inefficiency in that space and a lot of opportunities, to get their hands on. So I would club everything under that space: private markets, trade finance strategies, so liquid debt, then PD, private markets, so infrastructure equity, infrastructure debt, private equity, everything within that bucket. Now, obviously, within that, family offices and other investors may have a preference for a strategy versus a more liquid, because of preference, where they are in their asset allocation. So that would vary. But as a trend, we're seeing an increase across all types of private market strategies.
Yeah. Well, that makes sense as an extension and a complement to probably where they first dipped their toe in private markets, which is the seed and the early series equity space.
Yeah.
That's the first step for lots of family offices, was acting like a VC and going direct, and now we see so much co-investment, so much deal sharing. So that's the one of the core, if not the core, conversation for family
they're becoming
offices.
more and more sophisticated, and they want to see it on the board table rather than sort of just being a fund investor. They want to have an active say.
Now this direct equity or direct deal side of things is maturing. They've still got a long way to go, but it's maturing there. I think the private debt side of things, which complements that, the debt funding side of things, has got a long way to go.
Which is right behind private equity, but increasing in size for sure. No doubt about that.
So how long's Riverrock been around?
So from 2009.
Okay.
Right, so the timing is interesting. When banks were pulling away, which is when you'll find a lot of private debt firms originating. So 08, 09, GFC, banks retrenching capital, firms like Riverrock cropping up, and obviously lending in the SME space. So yeah. So
And the founders were coming out of a banking background? Or?
They were, yeah, actually. So 6 partners in the firm, and they all are from investment banking backgrounds and have core experience in lending to SMEs. So they ran large SME lending books at their respective banks, so Bear Stearns, ING, and various other banks. And they've all sort of come together. And the firm was set up by Roland Berger, who retired a few years later. But then the current CEO, who's a majority stakeholder, Michel Perretti, he was a CEO of Bear Stearns International, has a lot of experience in credit, and has put a very experienced team together, to run. So we currently stand at about 1.3 billion, and with a number of significant deals in the pipeline. So
fantastic. So it started in 2009.
Yeah.
Often those businesses that start, at the depths of a recession are the strongest. So what's the timeline been like since then?
Yeah, so as I said, the business started in 2009. Roland Berger, founder, chairman at the time, set it up. In 2013, actually 2014, he retired. Michel Perretti joined the business in 2013, which is from that point on, the business has really evolved. So it's gone from a bilateral SME lending firm and expanded across the alternative credit space. So just from going to SME lending, we're now looking at various types of lending projects. So working capital lending, infrastructure debt, real estate debt, special sits. So the product suite has really expanded to encompass all the niches within alternative credit.
I imagine there's, if you're European focused at the moment, there's quite a bit of opportunity around the world. Are you looking to grow significantly from where you are on an asset basis now?
Asset base, yes. Geographically, probably not for the next few years, because there is enough, as you said, enough opportunity. And we feel that with European government intervention programs, the SMEs are a lot stronger in Europe compared to the US. So we think that actually investing in the European lending space is significantly lower risk. I mean, it's a general statement. Obviously, within that, there'll be individual cases, but as a whole, European SME lending is we consider a lot safer, with Germany, Italy, Spain, UK, just having very generous support packages, and we've seen that. We've gone through a COVID cycle, so we've seen that. Whether it's employee support packages, whether it's been sort of tax rebates, and that's really helped businesses, and that's really helped our lending business. So we feel we're going to be focusing on this space for the foreseeable future.
Fantastic. So and how have investor appetites towards this style of investing evolved over the time you've been working in it? Are you seeing that appetite increase as understanding increases a bit more, or is it something they're very...
Yes. That's been as a result of investors wanting to diversify away from traditional asset allocation, so equities and just plain vanilla bonds, into more esoteric niche strategies where they know that they could get higher returns for the same, or in some cases lower risk profiles. So as investors sort of look to diversify their portfolios, and increasingly businesses like ours are adapting and incorporating, as I said, ESG, more positive ESG filtering, which is where investors are demanding products. The combination of the two has really meant that the whole space is growing, not just Riverrock, but across private debt funds. They've seen an uptick in fundraising. And that's been really good for the business.
How's fundraising been this year? What's the appetite been like?
Actually, it's been really good. So you would have thought that actually it would have been very uncertain with investors not putting money away, but we've got to remember, especially across Europe, with negative interest rates, insurers and large pension funds and family offices losing money on a cash basis, it makes sense to deploy that. And whilst you're still unsure of how the pandemic will plan out and what will happen in 2021, which is why I said earlier, to my point, that liquid strategies have seen an uptick because it's a good, safe, low risk, high single digit return, whilst you sort of analyze what to do next.
Yeah.
But it's also fair to say that these are not tactical bets or not tactical allocations. They are strategic, because the space is growing with banks pulling away. There is I forget the number, but a very large, in the trillions dollar gap in these SMEs not being able to loan from banks. So there's a huge gap, huge potential.
Incredible. Sounds very exciting.
Yeah.
And how about you? I mean, we've known each other for probably like 5 or 6 years now. How did you tell everyone a bit more about how you kind of got to this point? I know you were at Millennium for a while, and a few other brand names. How have you built your career to here?
Yeah, so I've always been in sales for the last sort of 12 years of my career, and predominantly in FX, so FX hedge funds. I'd like to separate hedge funds and FX, because FX can also be seen as asset allocation and more from a risk perspective rather than alpha perspective. On an alpha perspective, FX hasn't done very well, and an opportunity was presented to me late last year in the private debt space, and just having read so much about private debt and the scope of it and the expansion and what investors are doing, especially moving away from FX. Obviously, hedge funds is still a core part of their portfolios, but not necessarily FX, because FX sometimes is hard to find a home for. Is it a hedge fund? Is it just a risk management tool? What is it? And having spent so many years there and having thoroughly enjoyed it, I decided to make a switch. But I can say, safely say that it's been a really good move. Not only are we lending to SMEs, but I'd like to say we're making a difference, because we are making an impact. We're lending to SMEs where they are then having an impact on their investor base and the companies that they interact with. So it's in the past, people have thought that equity holders are the ones that can make an impact on business because they have a seat on the board. Shareholders can sort of change policies and board members' views, but increasingly, so debt holders are increasingly playing a part. There's been a gap in the market, and debt holders have now got a say, because effectively you're lending to a business, so you have a say as to how that money is spent.
And just a little bit about the instruments. So, I mean, convertible notes would be very common for this kind of stuff in the US. Are we using convertible notes?
We are not using convertible notes. We work closely with a PE strategy that are using convertible notes, where they obviously lend out, and obviously if the transaction doesn't go to plan, or they want to take over the management, then they would use that feature. But in the private debt space, no, it's senior secured, pure senior secured loans.
Okay. So by what mechanism?
With a lien on assets.
Okay.
Yeah.
So by what mechanism do the debt holders have some kind of say within the underlying?
By setting up positive covenants. So
Okay.
yeah. So with the covenants, they have in the past, especially with banks, known to sort of be a bit loose. But with banks retrenching away and SMEs having sort of in some ways, a limited source of capital, debt holders have a bigger say, in how that money is sort of used, how the business sort of puts that money to use. They have much more of a say. So it's not just the guy who owns the equity, it's the debt holder. Through structuring a number of covenants, whether it's the leverage, it's what sort of businesses are they lending to, are the businesses that the SME lending to, have they got social and governance policies in place? Are they taking care of the environment? And they are, for example, in the covenant, they're supposed to produce annual reports. So that's a mechanism for a manager like Riverrock to actually see. And they can obviously then trigger the covenants if those policies have not been adhered to.
Fantastic. And moving into 2021, where none of us really know what's going to happen, we're sitting here at the end of 2020 with a vaccine which has just kicked in London the past 2 days.
Yeah.
We don't really know what's going to happen, but 2021 is looking a bit more positive than this year. What's in your plans for getting out there back into the world? Are you going to be travelling? Are you going to be meeting investors? Are you going to be staying on video? Are you going to be staying working from home? What's the plan for you?
I think 2021 will be interesting, and I'm sure everyone will have a different answer to how they envisage the next year rolling out. But I think a bit of everything, actually. maybe earlier in the pandemic, people thought, oh my God, everyone's going to be working from home forever. We're just going to video calls are so amazing. But then I think a lot of people have seen that they've got sort of video calling fatigue. There's only so much video calling you can do, and it doesn't really replace the sort of face-to-face connection that you build with people. You know, there are some aspects of that you can do on a video call, but I don't think it will ever replace the face-to-face meeting, the human connection completely. I don't see that ever actually changing, whether it's for due diligence purposes or whether it's for, you know, an introductory meeting. You do need to get a feel of the person, and what you can communicate in person, you really can't do a video. So what I see happening, for my business at least, and I'm sure that would echo across the industry, is there will be a lot more flexibility in working. You know, working from home won't be frowned upon, as employers have seen productivity has increased. You know, employees do want to show that they're putting in their best and they're working many hours and doing what's required of them in return for getting flexibility. So I think traveling won't disappear, but maybe reduce. Traveling will definitely reduce, and what can be done on a Zoom or a Teams call will happen, but then there will be maybe reduction, but not completely going away. Nor will the office setup go away, but the office system may evolve. So instead of having a number of desks, hot desking, which has been popular for a number of years, but maybe more so, pop-up desks, social clubs, you know, where people come together and sort of work on work, so where they have the opportunity to work, but also some social interaction, because working from home, you lose that aspect of you know.
I think especially for those in the front office, those client facing, everyone's very much missing that social connection,
which is why I'm here.
Which
is why I'm here. You know, I've been missing that. I mean, I do go into the office once a week, but I like this sort of setup much. I think I would adopt to a system like this.
Yeah, there's a hybrid.
Yeah, no, absolutely.
Especially, I know you've got young family at home.
Yeah,
it's lovely to be with that family most of the time.
But sometimes,
it's also nice to have.
Yeah, absolutely.
The professional environment as well.
Get up, dress up, and go out. You know, and just not be at home all day. And I think it can give you a fresh perspective. Otherwise, if you're sitting in your four walls, you could just, I don't know, it can bring you down a little bit, even though you might be busy working. And I think maybe this pandemic in some ways has changed the face of work life forever, and maybe for the better. You know, having such a flexible work-life arrangement.
Yeah, I'm hoping that will extend into the hedge fund world.
Yeah, no, absolutely.
Lots of our members, lots of our investor members as well. You know, they haven't really missed a beat. They had to adapt to some of the tech and some of the operational setups, but they've been able to work.
Yeah.
And they've been able to continue raising assets this year. They've been able to continue investing this year. It's just an adaptation.
You know. I think the system's going to become more efficient and adaptive, but not necessarily. I don't think anything's going to be replaced.
No, there'll just be an evolution. You know, we're trying to add some technology to make those connections a bit easier. Trust is absolutely
and
crucial.
What would have happened over a few years has actually happened in a few months. It's compressed. Absolutely.
Space, So
absolutely.
I think it's quite exciting, and actually we can all come out in a better spot.
I hope so.